Good morning. Please come to this wonderful chapter, Ind AS 16. What is Ind AS 16? Property, plant and equipment, PPE. So we are going to call it as PPE. And in notes also at some places, PPE would be written, which means property, plant and equipment. So tell me quickly, did you read or study a similar standard in accounting standard also? Yes or no? Yes. What was the number of that standard? AS10. What was the name of that standard? Same. Property, plant and equipment. So basically this deals with tangible assets. And for intangible asset, we have another standard, Ind AS 38. Ind AS 38. Okay. This is one of the very important standards, not only for your exam, but also for practical purposes. Can you visualize an entity which does not have property, plant, equipment? Entity which does not have property, plant, equipment, not even one property, plant, equipment. Entity which follows Ind AS also. Is it right? No. Even a small entity will have some computer, some office, some chair which he will buy. Everything can't be on lease. Is it right? So therefore, every entity, they follow Ind AS 16. Those which are under Ind AS compliance, they have to follow Ind AS 16. Is this standard important? Yes. Why it is important? Why it is important? So I incur some expenditure. The question will arise whether it needs to be capitalized, means added to the cost of the asset, or whether it should be charged to P&L account as an expense, charge it and finish it off. What should we do? This standard will tell you that. This standard will tell you which expenditure will be capitalized, which expenditure will be charged to P&L account. Right. Suppose you have constructed this office, okay, new showroom you have constructed, and then you asked Abhishek Bachchan to inaugurate that office. Abhishek Bachchan came, he cut the ribbon, he took 10 lakh rupees for inauguration, okay, and he gave some speech and then bye-bye. Will that 10 lakh rupees be added to this cost of showroom? Some of you are wondering yes or no. No. Or yes. You appointed one Pandit ji also for Satyanarayan Puja. It's a new building. Whether this puja expense of 10,000 rupees be added to the cost of building? No. You gave training to the employees how to operate so many devices in that new office. Like in your office, when boss comes, he teaches you how to use computers, servers and whatever instruments are there. 10,000 rupees spent on that also. Will that be capitalized? These are the questions which are coming to our mind. Like some of you are thinking this should be added, this should not be added, etc. This standard, very detailed standard, will tell you which expenditure should be capitalized, which should not be capitalized. Does it make a difference? The answer is yes. If you capitalize an expenditure which should have been charged to P&L account, what is the implication? Expenditure should have charged to P&L account, but you have capitalized it. You have capitalized Abhishek Bachchan's inauguration expenses. P&L account will be high, profit will go up, net worth will go up, asset value will go up. Okay, so you are overstating your profit. Is it a good thing to overstate your profit? No. Then your financial statements are not fair. What we have learnt in Ind AS 1, financial statement should reflect true and fair view of the financial position, financial performance, but you are deviating from that objective of fair presentation. Reverse can also happen. Expenditure should have been capitalized. You have charged it to P&L account, so profit is understated. That is also not a fair presentation. So therefore this standard is really important. So property, plant, equipment. First we'll see what is property, plant, equipment. I have a car. Okay, all of you see every day in the parking. Is it my property, plant, equipment, or is it my inventory? My property, plant, equipment. This car I have purchased from a dealer. I went to his showroom, I paid the price, I bought the car. Same car till yesterday was in dealer showroom. What will dealer call it? Inventory. Why it has happened? Same car yesterday was inventory in dealer's book, now it has become PP in my book. Because the purpose is different. The purpose has changed. For the dealer, the purpose was to sell in ordinary course of business. He has told me this is the price. Anybody who walks in the showroom, pays that price, can take that car. So for him it is a inventory meant for sale in ordinary course of business. But what is my purpose? Am I going to sell it? Is there any price tag I have put there? Anybody can walk in my office, ask the reception, I want to buy that car. How much is that for? No, that will not happen. We will sell it, but once its useful life is over for us, or some other reason, but it's not in ordinary course of business. First thing. Now you see that meaning of PP are held for productive use. Are held for productive use, or our second feature is and intended to be used for more than one accounting period. The purpose is to use it, not to sell it. Intended to be used, and intended to be used for more than one accounting period. If it is going to be used only for a few days and then its life is over, I can write it off. Then I don't need to apply this complicated Ind AS 16 for that purpose. Is it right? So usually suppose we buy this calculator and it is used for productive purpose. But what is the life? 6 months, 9 months, and then we are done with this asset. We buy another. So I am not going to apply Ind AS 16 for this purpose because its use is not for more than 1 year. Its use is not for more than 1 year. The moment the use goes beyond 1 year, then this complicated Ind AS 16 gets applied and they are not made available for sale in the ordinary course of business. Then that item will become a property, plant, equipment, and of course this should be tangible. Because for intangible also we have similar definition, but they are intangible, they don't have any physical substance or appearance. Ind AS 16 prescribes specific accounting treatment for PPE. So when will you come to Ind AS 16? When that particular asset meets the definition of PPE. If it is not PPE, Ind AS 16 is not applicable. So I have to prove that this item is PPE for me. One more example. I have a flat which I have given on rent. Okay, I am not using at all for my business purpose or office purpose or administration purpose. Bought it, give it on rent. Will Ind AS 16 be applicable here? No. Why? Because this is called investment property under Ind AS 40. So Ind AS 40 says, I am going to take charge now of the accounting, not Ind AS 16. Is it right? Because it is not meant for use. Okay, in production, administration. So therefore this standard will not be applicable. So one has to first check whether it is a PPE or not. So what are the principal issues involved in this standard? In this standard we are going to first learn when to recognize a PPE, at what amount we should recognize a PPE, what will be the carrying amount of PPE, that is your after providing depreciation, impairment, how to provide depreciation and impairment losses. But impairment adjustment we will learn in another standard, Ind AS 36. So although these two standards are connected, but the calculation of impairment, which in itself is a let's say complicated affair, will be covered by a separate standard. What about depreciation? Depreciation will be covered by this standard only. Depreciation, we don't have a separate standard. It is covered in Ind AS 16 only for PPE, and for intangible asset in Ind AS 38. Okay. Now next paragraph, objective. What is the objective of Ind AS 16? The objective is very simple: prescribe accounting treatment of PPE so that it will help users of financial statement to discern information about PPE. What is the meaning of this line? Understand better about PPE. Now I will tell you practically this standard is very important. Suppose you go to take a loan from a bank. Bank will ask you, show me your balance sheet. Then bank will see how much is the fixed asset, PPE. What is the value of PPE? Suppose your PPE total is 200 crore. So what bank will think, in the worst case scenario, if the company fails also, I have PP of 200 crore. I can recover my money by selling the PP of 200 crore. So bank will say, we will give you a loan of 150 crore. Not 200, because they will keep some margin, or 100 crore, whatever the bank's policy may be. But suppose this itself was 20 crore, will bank give you 100 crore loan on that? The answer is no. So that is why PP has to be properly valued. When we calculate the net asset value per share of a company, we will take asset minus liability. Assets will include PP also. So therefore PP has to be properly accounted as it is used by banks, shareholder, okay, to understand what is the worth of a share, and accordingly they will either lend you or invest in this company. Next is scope paragraph. Quickly, scope paragraph means where it is applicable or not applicable. So the standard should be applied for accounting of PPE. That is, wherever you find there is a PPE, the standard is applicable. But there are exceptions, because there are some other standards which deal with certain items which are like PPE. So in that case, go to specific standard dealing with that item of PPE. Like for example, PP classified as held for sale. I have a car, but this car is now held for sale. Held for sale covered by which standard? Ind AS 105. That means my objective of having this car now is not to use it, but to sell it. Not to use it, but to sell it. And it is not my inventory also, because this is not my business. I have a car in the parking. You see every day. Yes or no? Do you see my car? No. Tomorrow you will see. Okay. So, it is not to be used. It is not my inventory item also. So, there is an in-between situation called held for sale. This is held for sale asset. So, this standard is not applicable. Which standard is applicable? 105. We will take after some days. And then there is a biological asset. Biological asset, for example, we have cow, ox, buffalo, sheep. Cow is to be used for more than 1 year, right? So the standard is not applicable for such biological asset, but there is an exception here. Again, exception to exception, that this standard will apply to bearer plants, but it does not apply to the produce of the bearer plant. So what is bearer plant? Plants which generates fruits or vegetable. Plants which generate fruits or vegetable and their life is more than 1 year. Like mango tree, apple tree is a bearer plant. Which stand is applicable? Ind AS 16. It's an exception. Okay. But for other biological asset, Ind AS 41 is applicable. Then recognition and measurement of exploration and evaluation asset. Ind AS 106, that is those assets which are used in exploration, okay, evaluation, which are used for extraction of oil, gas, mineral resources from the earth. There is a separate standard for that, 106. Okay. For the time being, it is NA, not applicable in your syllabus, 106. So no discussion on that. Again, same item, D. Mineral rights and mineral reserves such as oil, natural gas and similar non-regenerative resources. This is also not applicable in our syllabus. However, the standard applies to PP used to develop or maintain the asset described in B or D. Now understand what is this point. Suppose I have a tractor. I am using the tractor for management of biological asset. Yes or no? Or I have a computer where I keep a record of all my animals and plants. Ind AS is applicable to computer. Ind AS 16 is applicable to computer or tractor. It may not be applicable to other biological asset, but it does not mean it is not applicable to the company as a whole. It is applicable to the entity for other PP item. An entity accounting for investment property. Investment property is covered by Ind AS 40. Okay, but there is a connection between the two. What is the connection? Ind AS 40 shall use cost model in the standard for owned investment property. So in our current standard, Ind AS 16, we have two models for accounting: cost model, revaluation model. Because you have studied AS 10, you will remember. Cost model of Ind AS 16 is fully applicable to Ind AS 40, fully applicable. So whatever we will learn cost model today is applicable for Ind AS 40. So that time we don't have to put the same amount of energy. Is it right? Okay. Let us revise this scope paragraph again. The standard is not applicable to non-current asset held for sale, biological asset, but if the biological asset is a bearer plant, this standard is applicable. Not applicable for exploration and evaluation asset covered by Ind AS 106, not applicable to mineral rights and mineral resources, not applicable to these items. Other than that, the standard is applicable to all property, plant, equipment. If it is an investment property, then the cost model of Ind AS 16 will apply to investment property. Now I will take you through some important definitions because this will be required for subsequent discussion. The important ones. First is, what is carrying amount? What is carrying amount? So carrying amount is the amount at which asset is recognized after deducting any accumulated depreciation and accumulated impairment loss. So carrying amount means, so for example, you have purchased PPE for 10,000, depreciation provided till now 2,000, impairment provided, for example, so far 1,000. Accumulated means from the beginning. From the beginning the asset was available for use. So if it is a 5-year-old asset, this will be depreciation provided over 5-year period. So what is the carrying amount in this example? The carrying amount in this example will be 7,000 rupees. Many times they will use the term carrying amount, which means this figure they are talking. If they say cost, they are talking about this figure. So you have to be careful because questions will use the term carrying amount or cost. Cost means this figure without deducting depreciation and impairment, and carrying amount means the last figure after deducting depreciation and impairment. Now next is the meaning of the term cost itself. What is cost? Cost is the amount of cash or cash equivalent paid. Suppose you want to buy a machine. So what will be included in the cost? Most probably you pay cash. That is what you know in general, cash paid, or cash equivalent paid, or cash equivalent paid. If not cash, something which is equivalent to cash, like a investment, like a short-term investment. Short-term investment, highly liquid investment are called cash equivalent. Or you may have given consideration in other form, like you have purchased this machine, in return you have given inventory, or you have given a car. So fair value of the inventory or fair value of the car given will also form part of the cost given to acquire an asset at the time of acquisition or construction. Cost means cash, cash equivalent, or fair value of any other consideration. Fair value of any other consideration can be inventory or any other tangible or intangible asset, or even the service provided, okay. So you have suppose a computer shop. So I will teach you FR, you give me one computer. Possible? So what will be that? Fair value of other consideration. So I will see what is the value of the tuition that I have provided, and that will become the cost of the computer I have purchased from you. Is it right? Where applicable, the amount attributed to that asset when initially recognized in accordance with the specific requirement of other Ind AS, for example, Ind AS 102, Ind AS 102 share-based payment. Make it Ind AS 102 share-based payment. Now we have another chapter which we will take later, that is called share-based payment. If I have acquired a machine by issuing shares if I have acquired a machine by issuing shares of my company, this will be covered by which standard? Ind AS 102. Ind AS 102, share based payment. So there, this standard will tell you how to value the machine. Is it right? When you acquire a fixed asset or PPE by issuing shares of your company, the initial recognition, who will guide you? 102. They will tell you at what amount this machine would be recognized. So this is the cost of the machine. It can be cash, it can be cash equivalent, it can be fair value of any other consideration, or it can be company's own equity shares issued under Ind AS 102. Now, next you come directly to the definition of property, plant and equipment, PPE. Can you see that? PPE, property, plant, equipment are. So this standard is applicable only if the definition of PPE is satisfied. If it is not PPE, this standard is not applicable. So first feature of PPE, that these are tangible items. First feature of a PPE, these are tangible items. That means there is a physical existence. What is the difference between tangible and intangible item? These have physical substance. You can see this car. Intangible asset do not have physical existence. Okay. Second feature is, this tangible item should be held for use in the production or supply of goods or supply of services. That is the important feature of PPE. These are held for production or supply of goods or supply of service, or for rentals to others, or for rentals to others. So this car given on rent, this car given on rent, which standard will apply? Ind AS 16 will apply. Is it right? Then, or for administrative purpose, or for administrative purpose. Any example of a PP used for administrative purpose? Computer. Yes, computer can be an example. Your attendance is counted using an attendance machine. Is it right? Barcode readers. So, lot of machines you see around you here are administrative purpose and are expected to be used during more than one period. This calculator, which you see every day, it will meet the definition of tangible asset. It is used for rendering of services. It is not used for rental, but that is either or condition. It is used for administration and it is used for more than one period. If it is used for less than one period, then I will not capitalize it as PPE. Rather, I will treat it as other items and I will write it off as and when it is consumed. Okay. So, can calculator be a PPE item? Yes, because theoretically all these points are satisfied. But of course, because its value is very low, so many times what we do, in order to reduce our accounting load, we will write it off in the same year. We will write it off in the same year. That is also mentioned in the standard. You have studied about materiality in your Ind AS 1. So, capitalizing an asset of 300 rupees when a company's turnover is 1000 crore rupees means it does not make any difference whether you write it off or capitalize. So, one has to take care of materiality. Is Ind AS 16 applicable to bearer plant? Yes, Ind AS 16 is applicable to bearer plant. It is not applicable to other biological assets. Then the student is asking, what is bearer plant? A bearer plant is a living plant. Living plant means dead or alive? Alive. Okay. If it is dead, then it is not a bearer plant. Is it used in the production or supply of agricultural produce? It is used in the production or supply of agricultural produce. What is agricultural produce? Example I will give you for understanding. Agricultural produce can be fruits, vegetables, okay. Even Ind AS 41 says milk is also an agricultural produce, like this, crops. So it will be used in the production of or supply of agricultural produce, is expected to bear produce for more than one period. That is why it is bearer plant. It is expected to produce for more than 1 year. So this mango tree or whatever tree is that will produce mangoes for many years and has remote likelihood of being sold as an agricultural produce except for incidental scrap sale. We don't sell mango tree. We sell the produce of the mango tree. When will mango tree be sold? Once its life is over, then it will be sold as a scrap item. So once the tree dies, only then it is sold. Otherwise its produce are being sold and you can use it for, it can generate produce for multiple years. Such plants are called bearer plant. Is it right? So you don't have to worry much about this because in subsequent discussion it will not come. But yes, bearer plant is also accounted like a PPE. You will capitalize it, you will depreciate it. 4 areas addressed by this standard. Now directly come to next paragraph, point number 5. Which are the areas covered by this standard? First is the amount at which the asset should be recorded initially on acquisition. So that will be my first task today. At what amount PP should be recognized in the books. Second is how value changes subsequent to acquisition should be reflected in the accounts for both value increases and decreases. That is, it deals with revaluation, depreciation also. Okay. If suppose the value of the asset goes up, what we will do? Is this covered by this standard? Yes. That is called revaluation. How to allocate? How to allocate the depreciable amount over the life of the asset? That is, depreciation is also covered by this standard, and then it deals with also the accounting treatment at the time of disposal of the asset. These are the areas we are going to cover. This is our scope of work for next 1 or 2 days. Is it right? This is a little lengthy standard, but very interesting and very useful. Now we'll come to recognition paragraph. There are 2 conditions, and this you will find in almost every standard where recognition of asset has to be done. 2 conditions must be satisfied before the asset is brought into the books. So an entity will recognize the cost of an item of PPE as an asset only if it satisfies 2 conditions. Do you remember which 2 conditions? First condition is that the entity expects a future economic benefit from that item of PPE. If an asset does not generate future economic benefit, it is not an asset. You have seen the definition of asset also. Asset is a resource controlled by the entity arising out of past event which generates future economic benefits. So if it is not going to generate future economic benefit, will you still capitalize in your books as PPE? The answer would be no. For example, a company has constructed a village school. As a part of its CSR responsibility, okay, corporate social responsibility, companies have to spend some percentage of profit for social work. So what they did, the company is situated in Chennai, and the company has constructed a school building in a village in Jammu, will they get any future economic benefit out of it? Village school building is a PPE, in general building is a PPE. But the question is whether this building will be shown in the balance sheet of this Chennai based company. No. Why? There is no future economic benefit. Are you going to produce something there? Are you going to provide some services out of this building? Are you going to do some rental activity in this building? Administration work? Nothing. So therefore, there is a chapter in your syllabus also, CSR, accounting of CSR expenditure. That time you will see, even if you construct something like a building, but that is a part of your CSR activity, it is not capitalized because the company does not get any future economic benefit from that item of PP. Second is, the cost of that item can be measured reliably. So this is there in every standard. You will capitalize the cost of PP if the cost of PP can be measured reliably. The cost can be measured reliably, and if the cost can't be measured reliably, then you will not recognize the PP till these two conditions are satisfied. Okay. Judgment has to be exercised by individual entities for determining whether individual items qualify as an item of PPE. So sometimes you may require some judgment whether we should call it as a PPE item or not. Okay. Now suppose there is a temple in the factory premise. Now this type of questions are difficult to answer. Whether a temple constructed inside a factory premise is a PPE item? No future economic benefit, or future economic benefit is there. Class is divided. So these are places where judgment will be exercised. Okay. Somebody may say that when we have temple, people feel blessed, people have energy, people get motivation, and then they put more efforts in the work. Okay. Somebody will say it's of no use. Okay. So no future economic benefit from that. So some judgment may be required at certain point of time. Okay, now next is aggregation criteria can be applied for insignificant item to capitalize an asset. What do you mean by this? Aggregation criteria can be applied. If you have suppose large number of chairs, do I need to capitalize separately each chair? There are 300 chairs in this classroom. Do I need to capitalize separately, or we can add it as one? Yes. But simple example would be electrical fittings. Electrical fitting, you see so many electrical fittings are there. Okay, so many switches, switchboard, panels, all these are there. Do we capitalize separately, or can we aggregate them? We can aggregate them. Okay, so furnitures, because individually they are of small value, but together it's a significant or material value, they can be aggregated. Electrical fittings are all together, we write one line item or one account we open for electrical fittings. So they can be aggregated and then they will be capitalized as an asset. What about the treatment of spare parts, standby equipments and servicing equipment? So all of you know what is spare part. Spare part. Does your vehicle have spare part. Yes, in case the main part stops functioning, so before you go to the market and buy that part, you can use the spare part, that extra part. Okay, that is extra part. Like this projector, we have an extra bulb. So if this projector does not work, don't think your class will be off. We will use the spare bulb, change it immediately, and start teaching again. Or in your car there is a stepney. Yes or no? Even in your two-wheeler there might be certain spare parts. So that is one thing. Second, standby equipment and servicing equipment. What is standby equipment? Additional equipment. Additional equipment, like in a hospital there are additional generator sets. Okay. Or in theaters also there are additional generator sets. Why? If one fails, they can immediately switch to the other, because these are such businesses, hospital, theaters, maybe factories, where they can't afford a shutdown. Is it right? Life will be shut down. So therefore they keep extra so that immediately they can switch to the other equipment. That is standby servicing equipment. That is for servicing your other assets. What about this? Should this be capitalized or should this be shown as inventory? So here it depends on what is the type of spare part. Okay, accordingly we will do the classification. Second question is, what about their depreciation? So both questions we are going to answer in this table. First is major spares. Major means significant, and major standby equipments, which are expected to be used for more than one period, which are expected to be used for more than one accounting period, then this will be recognized separately as PPE and will be depreciated over their own useful life. Over their own useful life. So if this spare part has a life of 5 years, it's a major spare, it can be used for more than 1 year, then in that case it will be depreciated over 5 years. Okay. Second point, spare parts and servicing equipment which can be used only in connection with a particular item of PPE. A certain spare part can be used only for a certain PPE item. There are some lamps which can be used only with this projector. Lamp which I have purchased for Hitachi projector, I cannot use it for Panasonic projector. Right? It happens in some mobile chargers also nowadays. Even laptop chargers, you can't interchange them. So in that case, if it is a PPE specific spare part, if it is a PPE specific spare part and it can't be used with other PPE item, then it will be recognized as PPE. But what about its depreciation? Your laptop charger can be used only for a particular laptop. Okay. Your laptop life is 3 years. What will be the depreciation period for this charger now? 3 years. So when the spare part is asset specific, then it will be depreciated over the life of the main asset. Understood? Because after 3 years, once your laptop life is over, this charger in any case is not of any use. Why? It was supposed to be used only with a specific item of PPE. And the other items, other means these are not major, these are not asset specific, then the standard says you expense them as and when you use them. Expense them as and when you use them, and whatever are the unused item will be shown as an asset in the form of inventory in the balance sheet. Is it right? So you may have purchased 100 spare parts, 80 are used. So 80 will be charged to P&L account, but 20 is still in hand in the balance sheet, which will be required for next year. So that will be shown as inventory item in the balance sheet. Okay, so now to keep you awake, we will take some question answer. Come to question number 1. Comment on whether the following items purchased by an entity can be recognized as PPE. First is a small spare for 5,000. Second, standby equipment expected to be used for 3 years. Which is to be capitalized, which is to be expensed? First one is to be expensed, second one capitalized. Okay, write down the answer. Answer of first one, small spare for 5,000. So the answer of this is charge to profit and loss account. Charge to profit and loss account. Then answer of the second part, to be recognized under the heading property, plant and equipment. To be recognized under the heading property, plant and equipment. Okay, so that was just a warm-up exercise, okay. This is not your exam oriented question. They don't ask even in intermediate. Now there is a note. Cost of item that do not directly result in future economic benefit to the entity. There may be lot of assets in the business which may not directly result in the future economic benefit. Neither they generate revenue nor they help in cost reduction, but is required for future economic benefit derived out of other assets, but they are required for future benefit to be generated by other assets, like a chemical handling plant. Okay, a chemical handling plant is used by many companies to comply with the environmental requirement. What is the law of the country? The law of the country is you will not dump waste product directly in the river or in the environment. You have to process it. Okay, you have to process it, and only then you are allowed to discharge chemicals. So therefore this company has to fit this chemical plant so that it can comply with the environmental related regulation, otherwise it will be penalized. Okay, so whether this chemical plant chemical handling plant will be capitalized, the answer is yes. These are called enabler assets. Enabler asset. ENABLER, enabler. Keep writing, important terms. So enabler assets are also capitalized because their presence is required for to generate benefit from other assets. Now there is a question on that. Okay, there is a question on enabler asset taken from one of the ICI material only. When they give such long answers, you can understand it is an ICI question. Okay, answer is printed. Don't worry, enjoy. ABC Limited is setting up a new refinery outside the city limit. In order to facilitate the construction of the refinery and its operations, ABC Limited is required to incur expenditure on the construction or development of railway siding, road and bridge. So what is the construction? They have to construct railway siding, road and bridge. though ABC Limited incurs or contributes to the expenditure on the construction or development, it will not have ownership right of these items. It will happen with you also. When you will open a factory, you need to construct certain roads so that goods can be transported to your factory. You have incurred the expenditure on the road, but do you own the road? You have constructed some bridge so that it will facilitate movement of goods, but do you own that bridge? No. It will not have ownership right, and they are also available for use to other entities and public at large. So if you construct the road, which is the government property, anybody else can also use it. Now there is a critical question: what about the expenditure incurred on such asset? Whether ABC can capitalize expenditure incurred on these items as PPE? If yes, next question, how they should be depreciated? Although we have not covered depreciation till now, but you have idea about depreciation because you are a final candidate and presented. So 3 questions are there. According to question, one has to learn to design the answer. And if it is a theory question, you have to justify why this expenditure should be capitalized or should be charged to P&L account. But there is a hint in the question that they are asking you how they will be depreciated. This is possible only if your first answer is capitalized, okay, and then how they will be presented in the balance sheet. So this is an enabler asset. This is an enabler asset, and even enabler assets are capitalized, okay. So what they will do, whatever cost they will incur on this enabling asset, they will capitalize it over the cost of the plant. They will capitalize it over the cost of the plant because these are required to bring the plant into its working condition. If you don't incur this expenditure, the plant will not come to its working location and condition, and this will be capitalized over the plant, depreciated over the life of the plant, and presented as a part of the property, plant, equipment in the balance sheet, okay. So since the answer was very lengthy, I have already given the answer to you. Main points we will discuss. Come to this paragraph somewhere below after 2-3 paragraphs. In the given case, can you see that line? So in the exam, if you don't have time, you can start with this. First few paragraphs are basically the provisions of the standard, okay. Restitute, what it does, it divides the answer into 3 parts. First part gives you the provisions of the respective standard which deals with the given case study. Second is linking. What is linking? Case study with the provision, whether this case study fits into that or not. And third part is conclusion. And then if there are specific questions like depreciation, presentation, that will be subsequently discussed. This way you have to organize your answer in the exam. So I am not reading this part, which are just the plain paragraphs they have copied from the standard, okay. In the given case, railway siding, road and bridges are required to facilitate the construction of the refinery and for its operation. Expenditure on this item is required to be incurred, underlined, to get the future economic benefit from the project. As a whole, which can be considered as the unit of measure for the purpose of capitalization of the said expenditure, even though the company cannot restrict the access of others for using the assets individually. So sometimes it is possible that others might enjoy the benefit of that, but that does not mean you will not capitalize it. That does not mean you will not capitalize it, okay. It happens many times that we construct asset for ourselves, but others can also get benefit out of it. Is it right? If I put some trees and flowers in the boundary of my factory premise, don't you think outsiders are also enjoying the tree and the fruits and the flowers? Yes? Yes. It is apparent that the aforesaid expenditure, this is also important, directly attributable to bringing the asset to its location and condition necessary for to be capable of operating in the manner intended by the management. This is a condition for capitalization which we are yet to see actually, okay, that the cost which are directly attributable to bringing the asset to its location and condition as desired by the management. In view of this, now they are writing the conclusion of the first part. What will you do with that expenditure? In view of this, even though ABC may not be able to recognize expenditure on this asset as an individual item of property, plant and equipment, in many cases where it cannot restrict other from using the asset, expenditure incurred may be capitalized as a part of the overall cost of the project. So this you will add it to the cost of the project or the cost of the plant. Further, it can be concluded in the given case, the expenditure incurred on this asset, railway sidings. Do you know railway sidings? Railway tracks which are constructed privately, okay? Because in some companies, in order to transport the mine, especially in mines or factories, inside the factory there are railway tracks where the goods can be loaded and transported within the factory. It becomes very convenient, fast, cost effective. Road and bridge should be considered as the cost of constructing the refinery, and accordingly expenditure incurred on this item should be allocated and capitalized as a part of the PP of the refinery. So in one word, the answer is capitalize. Okay, this expenditure. These are enabler asset. These are enabler asset. These are directly attributable. These are directly attributable expenditure to bring the asset to its location and condition. Next question is depreciation. So once you have decided to capitalize, then you will depreciate it over the useful life. Okay. As per Ind AS 16, if these assets have useful life which is different from the useful life of the item of PPE to which they relate, it should be depreciated separately. So there is a concept called componentization accounting or component wise accounting. Okay, component wise accounting. What does that mean? If there is an item of PPE and suppose there are two parts, it has two significant parts. This part has a life of 10 years, this part has a life of 5 years. So what the standard says, you have to depreciate this part over 5 years and this part over 10 years. So now here we are capitalizing the cost of bridge, railway siding, etc. over the cost of the PPE. Life of the PPE and the life of these roads can be different. Roads may have only 3-year life. In 3 years they will get completely depreciated. Okay, so they will depreciate over 3 years. But the machine may have a 10-year life, so that will depreciate over 10 years. However, if these assets have a useful life and the depreciation method are the same as the useful life and depreciation method of the item of PPE to which they relate, these assets may be grouped in determining the depreciation charge. But if the useful life is same, then you can depreciate the whole asset as one asset. Okay, no need to do component accounting. So first paragraph says here component accounting. Next paragraph says no need for component accounting. if their useful life are same. Nevertheless, it has been included in the cost of PPE. If it has been included in the cost of PPE as a directly attributable cost, it will be depreciated over the useful life of the said PPE. The useful life of this asset should not exceed that of the asset to which it relates. If the life of the PPE is 5 years, life of bridge, road, railway siding cannot be more than 5 years for depreciation purpose. And then the presentation, the last part. This asset should be presented within the class of the asset to which they relate. What is the meaning of class of asset? Class of asset means land is a class of asset, building is a class of asset, plant and machinery is a class of asset, furniture is a class of asset. So, according to the class to which this enabler asset belongs, you present it there. Subsequent cost will be capitalized if the recognition criteria are met. What after 3 years again you construct the road, demolish the old one, again new one, again if the capitalization criteria is met, it will be again capitalized. What are the two capitalization criteria? Yes, come on. One, future economic benefit. Second, cost can be measured reliably. Okay. Now next item is, give the heading before that, replacement and major inspection. It is a new heading, replacement and major inspection. In fact, that separation, subsequent cost is also a new heading. When should subsequent cost be capitalized? When should subsequent cost be capitalized? Subsequent costs are capitalized if they meet the recognition criteria, that is, future economic benefit, cost can be measured reliably. Now the question is replacement and major inspection. This is a machine, okay. This is a component of this machine. Possible? This is your car, this is your tire. Car is 5 lakh. Component of this car, tires are 50,000. Life of car 20 years. Tires 5 years. Yes or no? So what I will do, I will depreciate this component over 5 years. After 5 years, its value will become, let's say 0. Let's say 0, no scrap value. Otherwise it can be having some scrap value also. So then I will purchase new tires or new component. Yes or no? So what the standard says, this old component will be, fill in the blanks, will be derecognized. Will be derecognized. And what about this new component which I am going to add? Imagine a car, okay. Old cars are removed, scrapped, disposed. So remove that from the books, whatever is the value left in that, and new component. What is a new component? New will be capitalized. Will be capitalized. It will be capitalized. Is it right? So this is how the accounting will be done when you are going to replace a major component of an asset. Same thing they have given for inspections also. This is something new for you. There are some assets which require major inspections. Major inspection, like aircraft, ship. Okay. The amount of money that is incurred on inspection is very high. So the standard says you will capitalize it. You will capitalize it and depreciate it over its own life. Over its own life means, suppose the law requires you should do the major inspection every 3 years. So you have done the inspection here, major inspection, incurred 30 lakh rupees on that. You can divide by 3 and you can write off 10 lakh every year. After 3 years, again you will undergo a major inspection. So again capitalize that, again depreciate it over its own useful life. Okay. So it says replacement at regular intervals, performance of major regular inspection qualify for recognition when the criteria are satisfied. Qualify for recognition means it will generate future economic benefit, plus cost can be measured reliably. Even the replaced part will be capitalized. So now I am going to take one question number 3, which you have to write in the notebook. What do you see? Aircraft. ASF acquired an aircraft. Okay, ASF acquired an aircraft. Only in the question. For rupees 15 lakh on 1/4/17. It has a life of 15 years. ASF is required to get the aircraft inspected every 3 years to check the travel worthiness. The law of the country says you have to get the aircraft checked every 3 years to check whether it is still travel worthy. It can be flown or not. Okay. Otherwise, there is a huge risk if it is not travel worthy. So on 1/4/17, it carried out inspection at a cost of 6 lakh. So this is a major cost. So you will capitalize this aircraft, and you are also going to capitalize this 6 lakh. But this aircraft will be depreciated over 15 years. But this inspection cost after 3 years. Again, what happened after 3 years? On 1/4/2020, it incurred 7,50,000 as the cost of the new inspection. So first I will depreciate 15 lakh divided by 15, 1 lakh, and this 6 lakh divided by 3, 2 lakh. So my depreciation in the first, second and third year will be how much? 3 lakh, 1 plus 2. But in the next 3 year, 1 lakh for the airplane, that aircraft, that will continue. But 2.50 lakh for the inspection. So depreciation for 4th, 5th and 6th year total will be 3.5 lakhs. Is it right? So do you want to write the answer or do it as homework? Oi, the plane is moving. Write down 1/4/2017. 1/4/2017. ASF Limited will recognize aircraft at rupees 15 lakh and depreciate over 15 years. And recognize inspection cost at rupees 6 lakh and depreciate it over 3 years. Now write down next line, 1/4/2017 to 31st March 2020. Next line, depreciation charge. Depreciation charge. So what will be depreciation charge? Right hand side rupees, point A. Depreciation on aircraft. Depreciation on aircraft, 15 lakhs divided by 15 years. 15 lakhs divided by 15 years. 1 lakh. Then write depreciation on inspection cost. Depreciation on inspection cost, 6 lakh divided by 3 years. 6 lakh divided by 3 years, right? 2 lakh. Point C, write down total depreciation per annum. Total depreciation per annum. Total depreciation per annum, 3 lakh. Now write down 1/4/2020. 1/4/2020 to 31st March 2023. To 31st March 2023. Depreciation charge. Right hand side rupees. Same presentation. Depreciation on aircraft. Will it change? No, it will remain 1 lakh. Its life is 15 years. So 1 lakh per annum will continue. Depreciation on inspection cost, that will change because your new inspection cost incurred is 7,50,000. So we'll take 7,50,000 divided by 3 years is 2,50,000. 2,50,000. Therefore, point C, total depreciation charge per annum. Total depreciation charge per annum. Is it 3,50,000? Come to next question number 5. 4, write down homework. Question 4 homework. Question 5 we will take. Then you should ask why 4 homework. 4 is exactly similar to 5. Okay. Only each figure is 100 times more than the question number 5 figure. Okay. So you will take my answer of question number 5. Multiply every figure by 100. Only don't multiply years by 100. Otherwise 10 year will become 1000. Amount you will multiply by 100 and you will generate the answer for question number 4. But you will try writing yourself. Question number 5 we will solve in the notebook. Okay. The institute answer you can delete. The institute answer can be deleted. What is the question? XYZ Limited has acquired a heavy road transporter at a cost of rupees 1 lakh. So initially they purchased a road transporter. So this is suppose a transporter, a vehicle, with no breakdown of the component part. What do you mean by that? With the no breakdown of the component part? It means it has some major components also, but I don't know out of this 1 lakh how much is for this component, how much is for this component, or how much is for this component. That is what usually happens. Am I right? When you buy a car, do you ask the seller, please tell me how much you are charging me for the tire? How much you are charging me for those mirrors, lights, seats, engine? Do you ask such questions? No. Okay, so that is one problem with component accounting. We will not be able to know what is exactly the cost of each component. So that is how to solve that problem they have given, with no major breakdown of the component part. So don't worry, the estimated useful life is 10 years. At the end of the 6th year, at the end of 6th year, 6 years are over out of 10, the powertrain, what is powertrain? Powertrain is a component, name of a component. Powertrain is the name of the component, requires replacement, as further maintenance is uneconomical due to the off-road time required. So now I am going to replace this power component. This is power component. I have to replace it. But I don't know what was its original cost. Okay. The remainder of the vehicle is perfectly roadworthy. Means this part is still roadworthy, no replacement required, and is expected to last for next 4 years. The cost of the new power train is 45,000. So this is one way to identify the cost of component. Now if you buy, which color? Black. Now this power train can be purchased for 45,000 now. But do you think its price was 45,000 6 years ago? Yes or no? No. Now my iPhone cost me 1 lakh. 6 years ago it was not 1 lakh. It was less. So I have to do backward working and find out what would be the cost of this power train 6 years ago. Okay. Can the cost of the new power train be recognized as an asset, and if so, what treatment should be used? Right there, assume 5% discount rate and straight line method of depreciation. The institute gives you the question also incompletely, and the student get confused. You need this 5% discount rate and you need the method of depreciation. Method of depreciation one can assume as straight line method in all questions where it is not given. But you need the discount rate to move backward. Is it right? So assume 5% discount rate. Then your question will be, if suppose this question comes in our exam, which I think in one exam they have asked also, what I should do? You will also assume some discount rate. Otherwise you will not be able to solve it. So you can assume a discount rate 5, 6, up to 10, 11. What is the role of this discount rate in this question? This 45,000 is the cost of the power train now. Now means at the end of 6th year, its cost is 45,000. So using this information, can I go back to year 0 and find out that if the discount rate is 5%, that is time value of money, what would have been the cost 6 years ago? So how do I find it? Discount it. 45,000 divided by 1.05 to the power 6. This is how we calculate the 33580. Yes. So now we have understood that out of this 1 lakh, 33,580 was the cost of the power train, and remaining amount, whatever is that, 66,420. Am I right? 66,420. Yes, that will be the cost of the remaining component of that asset. Do you agree? Then what I have to do? I have to depreciate this for 6 years. I will have to depreciate it and remove this part and add the new part. Remove the old part and add the new part. Remove the old component which is replaced and add the new part, that is 45,000 rupees part, add to that asset. Is it right? So that is the question. Can the cost of the new powertrain be recognized as an asset, and if yes, what treatment should be used? So write down a very easy question. The new powertrain, first of all, whether this new powertrain will be capitalized. Does it meet the capitalization criteria? So I am first commenting on that. That your question can be, why we are capitalizing it only? Why don't we directly charge it to P&L account? One, it will produce economic benefit. Write down the new powertrain. Powertrain is the name of a component used in the road transporter. The new powertrain will produce economic benefit to XYZ Limited, and the cost is measurable because 45,000 is given. Hence the cost should be, hence the item should be recognized as an asset. Hence the item should be recognized as an asset as per Ind AS 16, as the recognition criteria is satisfied. The original invoice for the transporter, did not specify the cost of the powertrain. Did not specify the cost of the powertrain. However, its cost of replacement is rupees 45,000. Its cost of replacement is rupees 45,000, which can be used as an indication of the likely cost, 6 years previously. It means we can use this 45,000, go backward and estimate how much was the cost of powertrain 6 years ago. Can we do that? So now write down approximate cost of powertrain, 6 years ago. Approximate cost of powertrain 6 years ago. Approximate cost of powertrain 6 years ago, 45,000 divided by 1.05 to the power 6. We are given the price here at 6 year. We are going to find out what was the price 6 years ago. So we are moving back. So you have to discount it. So the answer, round off it to 33580. Okay. Now write down current carrying amount of the powertrain. Current carrying amount of the powertrain. Current carrying amount of the powertrain. Original cost minus accumulated depreciation for 6 years. Original cost minus accumulated depreciation for 6 years. Did they originally follow component accounting? No. For them it was only one asset. So what is the number of years they might have considered for depreciation purpose. The number of years they might have considered for depreciation purpose is 10, because originally they did not divide the asset into two components. So the whole asset was getting depreciated as 1 over 10 years, over 10 years. So therefore this 33580, they were depreciating it over 10 years. So divide by 10, and how many years are over? 6 are over, which means they have depreciated for this many years. Now the book value of the component which is replaced, the book value of the component which is replaced is 13432. Now write down carrying amount of the road transporter. So this is the carrying amount of component. I hope this part is clear, first part. See how did we do? First we did backward working, got this figure, then depreciated it for 6 years, and today that is on the date of replacement, the carrying amount is this part. So this will be derecognized now. This 13432 will be derecognized. Next line write down carrying amount of the road transporter at the end of the 6th year. Carrying amount of the road transporter at the end of the 6th year. This road transporter was purchased for 1 lakh. Life is 10 years. Do we have any scrap value mentioned in the problem? No. So that means the whole transporter book value is how much now? 1 lakh minus 1 lakh divided by 10 into 6, 40,000. This is 60,000 is depreciation. Now tell me quickly to check your understanding. Does this 40,000 include this 13,432? This is my road transporter. This is the component. Value of this component we have calculated is 13432. And the value of this entire transporter, is 40,000. Of course it includes, no? Because this 1 lakh includes the cost of the powertrain. So this amount 40,000 will include the depreciated value of that powertrain. So now what will happen? This is my book value of the road transporter right now. This part we are replacing. So this will be removed now. The part which is derecognized will be removed now. And the new part will be added. So the question is, what will be the carrying amount of this road transporter after the replacement? Right. So we'll write it properly because we have to present in the exam. Important question for exam, 6 to 8 marks. Easily you will get it. Next line write down cost of the new powertrain. Cost of the new powertrain is rupees 45,000. Cost of the new powertrain is rupees 45,000. Understood? So now I am going to make a summary of how the cost of the road transporter will be, or the carrying amount will be now arrived at. So last paragraph write down revised cost of the road transporter. Revised cost of the road transporter. Right hand side rupees. Right hand side rupees. Then right hand side rupees, point A write down carrying amount of the road transporter at the end of the 6th year. This we have calculated 40,000. This is the value of the whole road transporter, okay, which includes the powertrain. The carrying amount of the old powertrain is 13432. Is 13432. So that will be derecognized. That will be derecognized. And the cost of new power train will be capitalized. Add 45,000. Last line, therefore, revised carrying amount of the road transporter. Therefore, revised carrying amount of the road transporter is 71,568. This is the benefit of component wise accounting. Otherwise, under old Indian GAAP, what used to happen? They were not bothered about all this. Once capitalized, it will keep depreciated, and subsequent replacement they used to charge to P&L account. Don't bother much. Whatever replacement means, everything replacement means charge to P&L account. That is what normally you do in your offices also. In companies which don't apply Ind AS, whatever replacement etc. we incur, we charge it to P&L account. But you should not do that if the component which is replaced is a significant one. Now see, the same question they have asked, which you will try as homework, because it is same. MS Limited acquired a heavy machinery for 1 crore. They have added 2 more zeros. With no breakdown, life is 10 year. Again at the end of 6th year, one of the major component, turbine. So only they are changing the names. Is replaced, no further maintenance is uneconomical. Remainder of the machine is perfect and is expected to last for the next 4 years. The cost of the new turbine is 45 lakh. Again they have added 2 more zeros here. Can the cost of the new turbine be recognized as an asset? If so, what treatment should be used? Assume 5% discount rate and SLM depreciation. Can you do that? So keep same space blank in the notebook. First write there question 4, page number, homework, and count the number of lines you have used in the previous answer. Okay. Now go to one very important paragraph, that is paragraph number 8. Measurement at initial recognition. Measurement at initial recognition. At what amount PP should be initially recognized? At what amount PP should be initially, that is first time you are bringing the PPE into your books of account, at what amount it should be recognized? In the previous paragraphs we have seen, when should we recognize? When should we recognize? When 2 conditions are satisfied. Cost can be measured reliably, future economic benefits will be derived from the asset. Now we are asking the question, at what amount it should be recognized? When we have answered, now at what amount? So this standard says, PPE will be initially recognized at cost. Why we are emphasizing on this line, initially recognized at cost? Because there are few standards, which will tell you that the respective asset will be initially recognized at fair value. Like Ind AS 109 financial instrument, there they will say the asset will be initially recognized at fair value. So we need to know for which standard they have asked you, cost or fair value. Okay. So PPE will be initially recognized at cost. So I need to, later on you can follow revaluation model, but on the day 0 it will be cost. So what will be the cost component? What are included in the cost? Now this is a very important paragraph in practical world, because which cost to be capitalized and which cost to be charged to P&L account, one has to be clear about it. Otherwise, cost which should be capitalized wrongly gets charged to P&L account, profit will be reduced. Reverse, cost which should be charged to P&L account gets capitalized, your profit will be overstated. So in your office, and when you do audit of client, or when you become CA and you are on the management seat, you have to know these are the cost I will capitalize and these are the cost I will not capitalize, which we will read. Okay. So what are the costs? First is the basic purchase price, which is called cash price alone if the terms are on deferred credit basis. What do you mean by this? For example, you purchased a machine and you are going to pay in 3 installments. 1 lakh rupees now, 1 lakh after 1 year, 1 lakh after 2 years. Can I say the purchase price is 3 lakh? The answer is no. There is a finance element included here. Because a seller who is going to give you a 2-year credit is going to include some interest on that. So what you have to do, you have to compute the present value of all future cash flows that you have to pay. Let us say, don't calculate, we will do it in some question later. This comes to 2,70,000. Let us say this comes to not 3 lakh but less than 3 lakh, 2,80,270. So we will capitalize it at this amount. And what about that extra 30 we are paying? That is finance cost. That is finance cost. If it is qualifying asset, finance cost is capitalized under India's 23 borrowing cost, which we have to study. But if it is not a qualifying asset, then it will be charged to profit and loss account. Second thing, so do not calculate anything right now. Non-refundable taxes will be added. What is non-refundable taxes? You don't get the credit of that tax paid. After deducting trade discount and rebate, trade discount and rebate will also be deducted. Non-refundable tax will be added. This is deducted, this is added. Like for example, you pay GST when you buy an asset. Then there are 2 possibilities. You will get the input credit for this, no input credit. This will be added to the cost of the asset, but this will not be added because this is like an advance payment of GST, which is later on adjusted. So non-credit GST you will add. Okay. So recently I purchased a car, example only, they charge me GST only, GST also, not only GST also. But then I got to know from my GST consultant that you don't get the input credit on GST paid on car purchased. It's a private car. So what I have done? Added to the cost of the car. Added to the cost of the car. But then I purchased a laptop also, this laptop which you see every day. On that also I paid GST. On that we can get the input credit. So then I will not add it. Examples are just near you. Cost directly, this is a very important line. Because many times we have to apply judgment. Like company has performed Satnarayan Puja in the office for inauguration of the office. Do we need to capitalize it? Answer is here. Cost directly attributable to bringing the asset to its present location and condition. Now Satnarayan Puja does not bring the asset to its present location and condition. Is it right? Not to be capitalized. Inauguration expenses. You will hire some celebrity who will cut the ribbon, charge 5 lakh rupees, give some speech, photograph session, but they is not required to bring the asset to its present location and condition. Okay, charge to P&L account. But if it is related, like freight inward. You bring the machine using a truck or a vehicle, and then you pay some transportation charge, unload it, okay, install it, then all this will cost you. Test that machine. An estimated cost of dismantling and removing the item and restoration of the site on which it is located. This is also added. Estimated cost of dismantling and removing the item and restoration of the site on which it is located. This is called decommissioning cost. In technical word, this is called decommissioning cost. Once you have, suppose this, you are getting a license for mining activity. Once the mining activity is over, you have to restore that area back to its previous position. That is called dismantling. Or suppose you have taken an office on rent, but for your own convenience, you might have put some internal walls, etc. That will have to be dismantled. So even the cost of dismantling and removing the item and restoring the site, it is also related, because that is the condition of giving you that place where you can operate. So it is a direct expenditure, but this expenditure may be paid later. If it is paid later, you take the present value of that. Is it right? But this is directly attributable, because the condition is you have to dismantle, restore, remove the item. So if these are incurred at a future date, we will take the present value of that. On that we have 2 or 3 questions coming soon. Next is example of directly attributable expenditure. Now I can only give you example, I can't give you a complete 100% list. Can it be possible? Different businesses may have different possibilities. So these are in general the cost which are incurred, which can be capitalized. Example of directly attributable cost. Cost of employee benefit arising directly from the construction or acquisition of the item of property, plant, equipment. And now be very careful, all employee costs are not capitalized. Will your boss capitalize your stipend? He has bought a machine, server, and he will capitalize your stipend cost? No. You are not directly involved in construction or acquisition of that. But suppose we are constructing a building. 5 of my employees are working in that building construction activity. So what I will do, if they work for say 70 days in a year on the construction of that building, I will add 70 days employee benefit cost to the cost of the building, right? Then cost of site preparation. Cost of site preparation, that is before you start construction work, before you install the machine, you may have to do some site preparation, leveling, okay, foundation work will also be capitalized. Initial delivery and handling cost, easy. Installation and assembly cost. What is installation? When you buy a machine, it comes in a big box. You have to open it, install it. Sometimes it comes in what they call semi-knockdown form. You have to assemble it. You may not have the expertise to do that. Then what you will do? You will hire somebody. Like when I bought this projector, it came in a box. I don't know how to install that projector. There is so much of wiring, there is a handle on which it is installed. All these connections have been done. Internal wiring, internal settings, programming have been done. That requires a cost. That will also be added. Then cost of testing also. When you buy some asset, you need to test whether it will perform, where the asset is functioning properly or not. After deducting the net proceed from selling any item, produced while bringing the asset to that location and condition, such as samples produced when testing the equipment. Now here we will get an adjustment in the exam. Suppose you have purchased a machine for making juices. Okay, juice, big machine. You can prepare 100 liters at a time. So what you will do? Start selling or testing first? Testing. So I was testing this juicer or juice making machine. In the process we produce 100 liters of juices. So my testing cost was 3 lakh and I realized 30,000 rupees from this sale of juices. Okay. So what I will do, because these are connected events, so I will take only net cost. I will take only the net cost. So these are two interconnected events. I am incurring the testing cost which gives me some income. So I will take the net cost and I will capitalize it. Next one is easy. Professional fees, consultant fees, architect's fees. Architect is the professional. He does the designing, drawing, then project managers who manages the whole construction activities, their fees will be capitalized. Okay. Next is cultivation cost of bearer plant. If it is a bearer plant which is also capitalized under this standard, the cultivation cost will be added. And then with this point we have discussed cost of enabler asset. Enabler, we have seen today one chemical handling plant example. Then one more example we had discussed was roads, bridge, railway siding. This example was taken, that is which are necessary for the operation of PP, for example road, fire safety equipment. Fire safety, this is another example. They themselves may not generate future economic benefit, but they are required to make other assets work. So the standard says even enabler assets will be capitalized. Now next is deduct any sale of scrap arising out of construction. Deduct. So when we are doing the construction work, let's say building, this cost will be capitalized, but there might be some scrap which is generated. What will you do with that? Don't show it as an income. You can deduct it from the total cost of construction, so that I will get only the net cost we have incurred. Similarly, deduct any damage received due to damage in the asset value. Deduct any damage. So if you are constructing a building, if some damages is caused by someone and you get some claim out of it, so then that can be deducted. So this will give me now the cost to be capitalized. Okay. Now the next point is which cost should not be included. Which cost should not be included. This is very important because practically also we incur a lot of cost which we should not capitalize. Otherwise it will amount to overstatement of profit. If you capitalize these expenses, it will amount to overstatement of profit, which is not good, which will not show your financial statement as a true and fair presentation. For example, cost of opening a new facility. Cost of opening a new facility. So when the companies start a new showroom, a new office, they incur puja expenses, inauguration expenses, staff training expenses will not be capitalized. Cost of introducing a new product or service. For example, advertisement and promotional cost. So in order to launch a new product, company may incur lot of promotional expenses. Will it be capitalized? No. Cost of conducting business in a new location or with a new class of customer. So company has a factory here in A, it shifts the entire factory to B. So there is a shifting expenses. Will this be capitalized? The answer is no. Shifting expenses of plant, machinery, etc. are not capitalized. Similarly, the cost of staff training is not capitalized. Staff may be trained for using machines, but then staff cannot be controlled. So Ind AS 38 will come, and Ind AS 38 will say, do you have control over the staff? Can you stop him from leaving the organization? The answer is no. So therefore staff training cost will not be capitalized. General administration, selling and other general overhead cost will not be capitalized. Allocated overheads will not be capitalized. However, just keep one thing in mind. If they are directly attributable, then capitalize. Directly attributable. So if an employee is involved in acquisition of a PPE, so even though the employee may be a supervisor in the company, but if he is involved in the acquisition, construction, purchase of a PPE, then that cost can be capitalized. Okay, electricity expenses. Suppose you are using the same power facility for construction of a building also. So don't you think some portion of that power cost will be added to the cost of the building? Yes. So if you can demonstrate that it is directly attributable, we can capitalize. Next is abnormal loss during construction, including its claim. So this question will come in your exam, abnormal loss of material. You purchase material of 1 lakh, material of 5,000 got wasted. Will you add it to the cost of the construction? No. Or suppose you have labor cost, but you paid wages for 15 hours which were idle. That wages cost will not be added to the asset cost. Initial operating losses will not be capitalized. Like for example, a practical example is Reliance Jio. When they started, first 6 months, it was an initial operating losses. Revenue was less, cost was more. Can they capitalize that loss? Instead of charging to P&L account, can I add it to the cost of the asset? The answer is no. So this will also come in some adjustment. Initial operating loss not to be capitalized. Any earning not related to construction. Any earning not related to construction, this will not be treated as a negative expenditure. It will be treated as an income. Like for example, again practically if you see, some construction work is going on. So what the companies may do, they may give some area for parking purpose or advertisement purpose. They will allow companies to put their holdings in that. What about the parking income received or advertisement income received? It will be treated as other income in P&L account. It will be treated as other income in the P&L account. That is called side earning. This parking fees, advertisement fees received when the construction work is going on, that is called side income. Side income which is not related to construction activity will be taken in P&L account. One student have asked a query, when we are doing testing and we get some income, We purchased a machine for making juice. We manufactured some unit of juice which we sold and we got some income. Here it will be net amount to be capitalized. But in case if you are giving the place for parking purpose, advertisement purpose, that is not to be adjusted. That will be taken to profit and loss account. Next very important point which we have already discussed, expenses incurred after the asset is ready for use. Once the asset is ready for use, actual use is not important, ready for use. Because many times what happens, a building is ready for use, but you say this building will have to be inaugurated by Virat Kohli. Virat Kohli is playing IPL matches. He will come only after 3 months. Management says, okay, no problem. We'll start this activity after 3 months. So what about the expenditure incurred between this 3 months period? Charge to P&L account because the building is ready for use or put to use, or expenses after manner intended by the management. So once the asset comes to a stage where it can be used in the way it is intended by the management, subsequent expenditure will not be capitalized. Once this projector is installed, ready to use now, and suppose I am not using it for 1 month, still the subsequent expenditure, if any, on maintenance or whatever will be charged to P&L account. So now some repetition will be there. Cost not included in the carrying amount of an item of PPE. Not included, underline. Recognition of the cost in the carrying amount of an item of PPE ceases, underline, when the item is in the location and condition necessary for it to be capable of operating in the manner intended by the management. Once the asset reaches a point where it can be used by the management in the manner they want to use it, subsequent expenditure will not be capitalized. Therefore, cost incurred in using or redeploying an item are not included in the carrying amount of that item. Once it reaches that stage, all subsequent cost will be charged to P&L account. Of course, subsequent cost will be capitalized when two conditions are satisfied. Future economic benefit and cost can be measured reliably. For example, following costs are not to be included. This is given in your Ind AS 16 only, this example, so I have taken it again. You may find it repetition. Cost incurred while an item is capable of operating in the manner intended by the management, has yet to be brought into use. Has yet to be brought into use means it is ready but not being used. What will I do? Do not capitalize the expenditure. I have purchased a generator set. You can see outside this building, okay, on that side. But there is no power cut only since I have bought it. Will I still capitalize the expenditure which are required, for example, some maintenance, some training, etc.? No, not required. Or is operating at less than full capacity. An asset is ready for use, but you are not able to use it to the full capacity. What about the expenditure? P&L account. Initial operating losses already discussed. Cost of relocating or reorganizing part or all of an entity's operation. So the standard says if you are shifting your location of asset, like some companies which may be in Pune, they may want to shift it to Mumbai. So there may be transportation cost, uninstalling and installing again. What about such expenditure? P&L account. So this is the summary given by the institute. So I have taken that same chart. What will be included and what will be excluded? Purchase price, directly attributable cost, and decommissioning or restoration and similar liabilities. will be added. This we will discuss in detail, and on this we have a lot of questions also to be covered. Okay, decommissioning expense means, suppose you have installed plant and machinery here for mining activity, oil exploration, nuclear plant, hydropower plant, but then the license given by the government says after 30 years you have to uninstall, decommission, restore the site. So there is a cost that you are going to incur for this purpose. The present value of that will be added to your PP now. Why? Because it is directly attributable. This is a condition for starting that operation, that you have to decommission all your whatever instruments you have installed there, equipments you have installed there, bring the area back to its original position. That is called restoration. So that is also capitalized. What is excluded? Quickly, cost of opening a new facility, operation cost example, then introducing a new product or service, advertisement and promotional cost, conducting a business in a new location with a new class of customer including staff training, administration and general overheads. These are to be excluded. Now, this is a good summary of how to arrive at the cost of PPE initially. Okay, so more or less we have covered the maximum thing that you need to add or less. So pay attention to this. First you will take the purchase price. Okay, then if there is any trade discount, not cash discount, trade discount or rebate will be deducted. If there is any interest you are paying for deferred payment beyond normal credit term, that will not be considered. I gave you one example. You are paying 3 lakh rupees, but the present value of the cash flow only comes to 270, which means it includes 30,000 rupees interest. So if I am writing 3 lakh rupees here, then I need to deduct 30,000, or what we will do, we will directly write 270 here. Both presentation is welcome. Either you directly write the cash price, or if you writing the installment price, then deduct the interest. This will give me first net purchase price. And then what are the items to be adjusted? What are the items to be adjusted? I will add any import duty which is non-refundable. All taxes should be non-refundable. Then any GST, for example, GST, VAT, octroi, okay, whose credit is not available, non-refundable. This is very important. Some judgment will be required from your side also. Directly attributable costs which are necessary for bringing the asset to its present condition, location, so that the management can use it in the manner they want to use it. Then you have to also add provision for decommissioning, restoration and other liabilities. This is in short we will call DROL. What is DROL? Decommissioning, restoration, other liabilities. So if you don't want to write every time provision for decommissioning, restoration and other liabilities, for the timing in the classroom you can write DROL. Now 2 standards deal with DROL because it is a provision. So India's 37 will teach you how to measure the provision. India's 37 will teach you how to measure the provision, and once you do the measurement of provision, you will capitalize it to the cost of the PPE. Okay, and then you will depreciate the PP after adding the DROL. Further accounting of that provision for DROL will be covered by India's 37. if you have received any grant, okay, which is related to that item of PPE, then there is another standard, Ind AS 20, which will ask you, which gives you two options. One is to treat it as a deferred government grant. The other option is to reduce it from the cost of the PPE. So if I choose that option, I will reduce it from the cost of the PPE. But in this chapter, we will not get much adjustment on this. But remember, this will be covered by Ind AS 20, where if the grant is related to an item of PPE, then we have two choices. Either you credit to a deferred grant account or you credit the PPE account. In that case, the PPE balance will go down. And then there is one more standard which says that if PPE is a qualifying asset, which asset? Then borrowing cost will be capitalized under Ind AS 23. So there are few questions, basic questions, where we have to capitalize the borrowing cost. Okay. So borrowing cost will be capitalized if it relates to qualifying asset. If it relates to qualifying asset, not every time. Qualifying asset is an asset which necessarily takes substantial period of time. Substantial period of time to get ready, okay, for its intended use or sale. So if I buy a car which is ready to use and I borrow money also, I get the loan from the bank and I buy the car, will the interest be capitalized? No, because the car is ready to use. So generally when we are constructing a building or we are installing a plant which takes substantial period of time, or if we have suppose we are manufacturing wine which takes substantial period of time, then borrowing cost is capitalized. And what is substantial period of time? It is left to the judgment of the management. So usually if you are close to 1 year, 1 year and above, you can immediately treat it as a substantial period of time, but institute have also treated 6 months and 9 months also sometimes as a substantial period of time. So when we are given a question where borrowing cost is there relating to some construction of a building or plant, what we will do as a student? Capitalize. Okay, up to the point when the asset is ready for use. Up to the point when the asset is ready for use. Okay. This will give me the initial cost of PPE. So this will be capitalized, it will be depreciated. Subsequent accounting we will discuss. Okay, don't worry. Now come to discounting in case of payment is beyond the normal credit terms. What happens sometimes, which is you are going to buy a machine, but the machine is very expensive. So what the supplier says? Don't worry, you pay in installment. Supplier is also enjoying, he has two benefit. His sales also increases and he gets the interest income also. You are also happy, even though you don't have the money immediately, you can buy the machine. So instead of going to a bank and then taking a bank loan, which takes a lot of time and the bank interest rates are very high, processing charges are very high, you pay in installment. But then the standard says, when you are paying in installments beyond normal credit terms, normally what credit terms you get in the market? 1 month, 2 months, 3 months, that may not include interest. But if you are paying in 4 years, 5 years, supplier is going to charge you interest. So calculate the present value. And what you get is called cash price. Capitalize at this amount. And whatever interest you will be paying in this installment, that will be treated as finance cost. or borrowing cost. Then which standard deals with borrowing cost? Ind AS 23. So if it is a qualifying asset, then the interest can be capitalized, but if it is not a qualifying asset, charged to P&L account. So we'll take one question on that, you will understand it better. First read the concept. The cost of PPE, underline, is the cash price. Cash price equivalent at the recognition date. If the payment is deferred beyond normal credit terms, the difference between cash price and the total payment is recognized as interest over the period of credit unless such interest is capitalized as per Ind AS 23. Make it 23. As per Ind AS 23. Unless it can be capitalized as per Ind AS 23. That will be a better presentation of your answer. Whenever any PP is acquired on deferred credit, which is beyond normal credit term, PP should be considered at purchase price of normal credit. Excess paid is treated as financing cost. IRR should be calculated for such interest cost and vendor account settled. What is IRR? Full form of IRR. Internal rate of interest, rate of return. IRR, internal rate of return. In some question you may be required to calculate IRR. For example, the question says cash price is 1 lakh, but the payment will be made in 2 installments, 60,000, 60,000. So you will capitalize the asset at 1 lakh, but what about the payment? It will include some element of interest. So for that we will have to calculate IRR to find out how much interest is included in these installments. If they give you the IRR, thank the institute. But if they don't give you the IRR, then we'll have to compute the IRR. Okay. Do you know how to compute IRR? Yes or no? Yes or no? We are not getting answers only. So today you will revise IRR calculation from FM book. Okay. In IRR what we do? We write cash flows. We assume a discount rate. Calculate the present value. Again we assume a discount rate. Calculate the present value. And then apply IRR formula. So using that formula you will be able to find out the discount rate. But today we will not discuss IRR, we will discuss it in other chapters also. This is also relevant for other chapters. Like in Ind AS 2 inventory we have already seen. If you purchase inventory on deferred credit term, purchase price will be equal to present value of the cash flow. Then in the chapter on intangible asset, same thing. Instead of machine they will give you purchase a software and paid in 3 installment. Do the same thing. 40. Investment property, quite popular. You purchase a building for 3 crore, but the payment may be made in 5 installment. Or Ind AS 115, revenue recognition chapter, where you are selling to a customer and he pays in 3-4 installments. So in all these cases, the initial recognition will be by calculating the present value of the cash flows. Okay. And if cash price is given, future cash flows are given, but IRR is not given or interest rate is not given, then the student will have to calculate the IRR so that he can calculate how much interest is included in each installment. Now time has come to solve question number 6, 7. Question number 6. On 1st April 20x1, an item of PPE is offered for sale at rupees 10 million, with payment terms being 3 equal installment of rupees 33,333,333 over 2-year period. Payments are made on 1st April and 1st April 20x1, 31st March 20x2, 31st March 20x3. The property developer is offering a discount of 5%, that is 5 million, if payment is made in full at the time of completion of the sale. Now this time in this question underline, this is IRR which they have already given. Otherwise we have to compute it. Show how the property will be recorded as per Ind AS 16. Now what is the total amount you have to pay? 10 million means 1 crore. How much is the cash discount? 5 million. 5%, 5 million. How can 5% be 5 million? 0.5. Make it 0.5. So 5 lakh. If somebody gives me 50% discount, it is too much. So 95 million or 95 lakhs, is actually the cost. And you are going to pay in 3 installments. The installments are 33.33, 33.33, 33.33. One will be paid now only. It's written 1st April. The other 2 installments will be paid at the end of year 1, at the end of year 2. Okay. But then these installments include some interest. Why it includes interest? Because total payment is 1 crore and you are booking the asset at 95 lakh. You are recording the asset at 95 lakh. So that 5 lakh is the interest component. So for that purpose, how much is the interest? We will use 5.36% as a IRR. If this was not given, you will have to compute it. So write down. First, there is a note in the book already typed in your book. Is it there? Is the answer format is there in your book? Very good. So we can save time. Ind AS 16 requires that the cost of an item of PPE is the cash price equivalent at the recognition date already typed in your book. Hence the purchaser that takes up the deferred payment terms will recognize the acquisition of the asset as follows. First, what I will do, only in the notebook you do this calculation. In this question, the cash price is given to you, but otherwise you can do the calculation yourself also. If the question would not have given the cash price of 95 lakh, we will calculate the present value of the future cash flow. At what discount rate? At IRR, that is 5.36%. Implicit rate means IRR. So draw this format. In every problem we can do it. First column write year, second column amount, third column discounting factor at the rate of 5.36%, last column present value. If this actually working note is not required because cash price is given in the question 95 lakh. Suppose it was not given. Suppose the question says you have to pay 33,33,300 in 3 installment. Implicit rate is 5.36%. Do the accounting. Then at what amount I will capitalize the asset? First I need to find out the present value. Write down. Year 0. Sir, what is 0? Today. Because you have to pay cash down of 33 lakh 33,333. The seller wants, you must make some investment, is it right? So most of the cases of installment will involve some cash down also, practically, right? If you have some involvement in the asset, you will be more sincere and careful about that. Present value of year 0 is always going to be the same. Next 1-2 write down. 1-2 means first and second year, per annum 33, 33, 333. This is 33, 33, 333 per annum. One student once asked me, sir, why don't you multiply by 2? Because we are paying 2 times. We are going to adjust the discounting factor, okay? So don't multiply this number also by 2 and take the cumulative factor also here. So do you know how to get that factor on calculator? So try with me, those who don't know. First, all clear. All clear? 1 divided by 1.0536 equal to memory plus, memory recall. You will get 1.849968 something. So you can write in 4 or 5 digits, no problem. Then multiply these two numbers. Multiply, how much you are getting? Approximately 61, 66, 561. Some difference may be there because some of you may be using 4 digits. Some of you are using all the digits which were there on your calculator screen, right? Don't worry. FR says keep in mind materiality. So if 10, 20, 30 rupees is different, it is not a material difference. Ignore, okay? So how much you are getting? 94, 99, 894. I am getting, you will also get around that number. So can I just say 95 lakh? Can I say 95 lakh? Which means this IRR which they have given in the question is correct. That was a cross check also, but not required in the exam. For this question, this working is not required. This working is not required in the exam because this 95 lakh is already there in the question. 1 crore minus 5%. Okay, 95 lakh is the cash price. Suppose it was not given, then this working note is required. If you have time, then do it. Now we'll pass journal entries. So everybody come back to your book. In your book, 1st April 20x1, you have purchased a property, plant, equipment. How much is the value you will put on PPE? 95 lakh or 1 crore or 33 lakh, 33,333. 95 lakh. Then 2 cash. How much will you pay right now? 233, 33, 333. Then remaining amount is your accounts payable, liability. That is amount payable to the supplier. 61, 66, 667. So this is your liability. This will appear in balance sheet. On that you will pay interest next year at 5.36%. Okay, that will include interest of 5.36% next year. First narration is printed, being initial recognition of property. Now I will come to 31st March 20x2. Tell me on this amount, 5.36% on this amount. 5.36% on this amount. 3,30,533. Wait, this is the interest component. You are paying an installment of 333,333. That includes 3,30,533 as interest component. So how much is the principal part, balancing figure. So accounts payable will be 30 lakh 2800. To cash and bank, 33 33 333. So this is your being recognition of interest expense and payment of the second installment. Now what I'll do, I will ask you to try the last year, last installment. Just entry I have given to you, put the numbers there, and then we'll check. Try yourself. Try yourself. Yes. How much interest you will write? Don't write interest figure right now. Okay, this is a trick you have to understand. First you write this figure, 33 33 334. Okay, or you can write 333, no problem. 1 rupee difference is okay. Now you check what is the balance left in accounts payable. What is the balance left in accounts payable? Because I need to close that account. So you had credited this figure and you have debited this figure. So at this moment the balance in that account is 61,66,667 minus 3002,800. So is the balance here 3163867? This number can't change. It has to be the balance in accounts payable. This number can't change. Maybe 1 rupee you can do plus minus. So balancing figure you transfer to interest. If you calculate by 5.36%, then there will be additional difference. Then some balance will again remain. And then balance again you have to adjust in interest only. So ultimately interest figure will be this. Is it allowed in the exam? Yes, very much. FR is a subject which says keep in mind materiality. If I add or less 5 rupees more interest, when the figure is lakhs of rupees of interest, will you as a shareholder shout at the management, oh you have made a mistake of 2 rupees in the balance sheet? Okay, please resign. Done? Hello, done? Done. Come to question number 7, one more practice for you, till you get it right. Okay, next is question number 7. A Limited purchased a machine for 10 lakh, whose payment is after 3 years. Date of purchase is 1/4/19. If such machine is purchased on normal credit, then its price would be 8,50,000. Past journal entries. Now in this question, there is a problem. Today, if you buy 8,50,000, but you are going to pay after 3 years. And how much you are going to pay? 10 lakh. So there is a interest involved. But some student, what they will say, interest is 1,50,000. So I will recognize 50,000, 50,000, 50,000. Is it right? No, it has to be based on IRR. But IRR is not given. So how do I calculate IRR? The IRR or R is that rate of discount at which present value of 10 lakh will be equal to 8,50,000. Present value of 10 lakh will be equal to 8,50,000. So we have to find that discount rate at which present value of 10 lakh is equal to 8,50,000. So does it remind you of your school level mathematics classes? PV is 8,50,000. Future value is 10 lakh. time 3 years, what is the annual compounded rate of return? You have to find out rate of interest which is annual compounding, not simple compounding. So this is basically, unless you get this figure, you can't pass entry in year 1, 2, 3. Previous question you were able to do it. So how do I get this calculation? I have done it below in your question book only, working note 1. Can you see working note 1 in your book? Say yes or no. In working note 1, I have written a formula which is the formula of a future value, present value into 1 plus r to the power 3. See, you have to know this formula every day. Remember this basic formula in time value of money. Future value is equal to PV into 1 plus r to the power n. 8,50,000 into 1 plus r to the power 3 is equal to 10 lakh. Which means when I simplify this, it will become 10 lakh. This is 10 lakh, divide by 8,50,000. And if I want to remove this power 3, then I have to take on the right side power as 1 by 3. That is called third root. Okay, solve. Can you solve it? Now there is a problem. The student is saying we don't know how to solve it. 1 plus r equal to, just tell me 10 lakh divided by 8,50,000 is how much? 10 lakh divided by 8,50,000. 1.1764705 something. Okay, that is enough. To the power 1 by 3 means 0.333333. Now there is a trick on the calculator to solve it. So write down the trick, because this will come in other questions also. Then you will send me an email, sir, how to solve power 1 by 3. I will ask you to first transfer 200 rupees using Paytm, Google, Phone Pay, and then I will tell you. Okay, today first time included in the fees. Okay. Then first you take 1.1764705 on your calculator, which I think is already there. Yes or no? Press square root 12 times. Press square root 12 times. Do not ask any logic for this. Take it or leave it. Okay. We are not going to give further logic. These are Indian jugaad, Indian tricks. Okay. Then what is the next we do? Minus 1. Type minus 1 on calculator. After pressing square root 12 times, minus 1. Multiply by the power. Multiply by 0.3333333333 till your calculator supports. Press 3333. Then plus 1. Plus 1. And now multiply equal to 12 times. Multiply equal to. Now tell me, you are getting some number on your calculator. 1.0556. Then you deduct minus 1. Then into 100. Yes. So the answer is 5.56%. So answer is 5.55 or 56%. This trick you will use in a question like this. Okay, when there is 0 year cash flow and cash flow on maturity, then this trick will be used. Very simple. With practice you can do in few seconds. Those who have not written so far, please write down these 5 steps. Whatever number is given in the base, suppose in the next question it is 2.35 something, take that number, press square root 12 times, press -1, multiply by the power. So these two things you have to change in every problem. Power can be different. Suppose it's a 10-year problem, the power will become 0.10. Yes or no? If it is a 5-year problem, power will become 0.2, 1 by 5. So accordingly change these two numbers, and then your simple calculator will also give you the answer. Such questions should not be asked in the exam, first of all. If they ask you, they should give you the value of this power. Is it right? Normally they will give you. If the power comes in fraction, they will give you the value of that power. If not given, then we have to use this trick. Mostly it will be given. Or they should allow scientific calculator, but it is not allowed right now. So the answer is 5.55%, that is your IRR. Using this now we can solve the problem. This is the rate at which we will calculate the interest. So I have taken two problems, one where IRR is given, which is usually the case in the exam, usually, and second, if IRR is not given, then how do we handle it? Now you can complete the journal entry. Start in the book only. Take a pencil. Please use pencil. If you have made mistake, it can be easily rectified. Okay. I will recommend you to use pencil, but if you are very confident, go ahead with the pen. So first entry on the date of purchase, 1/4/2019. PPE account debit, which figure, 10 lakh or 8,50,000? 8,50,000. To vendor account, 8,50,000 being machine purchased. At the end of the year, interest will be calculated. Interest account debit 8,50,000 into 5.55 or 56%, into 55 or 56%. How much is that? No problem. 47,175. 55 you have taken? Okay, take 55. No problem. Last year we will adjust the interest. To vendor account 47,175. If you have taken 56 also, then it is okay. No worry. Now wait a minute. What about this interest? Write in bracket P&L account. Because this machine is not a qualifying asset. It is ready to use. It is ready to use. So interest will be transferred to P&L account. Otherwise you will have to pass one more entry. Do you want to pass one more entry or just write P&L account here only? Here only. Okay. Then next year what will happen? Understand, the vendor account was 8,50,000. Add 47,175. We have not made any payment till now, so balance will increase, where I am going to pay the entire amount in the last year. After adding this, multiply by that 5.55%. So you will get interest account, anybody? 49793 approximately, plus minus 100 rupees, okay. If you are taking 55, this is the answer. If you are taking 56, then the answer will be slightly different, but don't worry, that is okay. To vendor account, we are not paying right now. So in bracket write down interest P&L account. Interest will be transferred to P&L account. Now once again you see, you again add this number in the vendor account on calculator. 850 plus 47,175 plus 49,373. This is the opening balance of vendor in the third year now. Multiply by 5.55%, or wait a minute. This is last year. So what we do in the last year? We have to make the balance 10 lakh. We have to make the vendor balance 10 lakh. So first to write this figure. to vendor account, in bracket write 10 lakh minus these three figures which I have credited to vendor account. So last year we will adjust the interest balancing figure, and this interest will go to P&L account. Interest in the last year is a balancing figure when we have used IRR, okay. And now tell me, what will you do? You will pay the vendor 10 lakh, vendor account debit 10 lakh to bank account 10 lakh to bank account 10 lakh being payment made to the vendor. These two questions you have understood. Same problem can be asked for inventory also. Same question can be asked for intangible asset also. Same question can be asked for investment property also. So I am not going to take the same problem there also. Understand, only what you have to do, change this figure, name. Remaining has nothing to do with PPE. So if it is a problem of inventory, I will write here purchases account debit to vendor account or inventory to vendor account. If it is intangible asset problem, I will make it intangible asset to vendor account. If it is investment property problem, I will write investment property to vendor, because remaining adjustments are simply adding interest to vendor account. Am I right? Same question can be asked in 4 chapters. One more question for you. Question number 8. Very small question. The total cost of a large computerized machine is rupees 40,000. Butter company do not have enough cash, so agrees to pay for it a year later. However, they will pay rupees 45,000. Explain the treatment. So you have to explain treatment of two things. What will you do with this 45,000 and what will you do with this difference of 5,000? What is the cost of the machine at which it will be capitalized? 40 or 45? 40. And what is this 5,000 you are paying for? Delaying the payment. It's a finance cost. So write down the answer. Such questions are only for understanding, not for exam. Not for exam. Today I had given you one homework. Have you mentioned that homework in the notebook? Have you kept the space also blank? Try yourself. The answer for this question number 8 is rupees 5,000 in bracket, that is 45,000 minus 40,000 will be treated as interest payable and not included in the cost of the asset. Then just add one more line. The machine will be capitalized at rupees 40,000. The machine will be capitalized at rupees 40,000. Okay. Now we'll come to one important discussion. This is in 2 chapters. In Index 37 also we have discussed about it. But there we have not taken numerical questions because we also need some knowledge of Index 16. So today I am going to take numerical question on provision for decommissioning cost, restoration and other liability. In short, we can call it droll in the classroom, not in the exam. Okay. Institute does not recognize droll. They will only recognize decommissioning cost. So at the most in the exam, if you don't have time, you will write provision for decommissioning cost. This is okay, but don't write in the exam. You have purchased an PPE here. It is required to be dismantled, removed, and the area has to be restored after 10 years. Okay. The question is whether this cost of dismantling, removal and restoration will be included in the cost of the PPE today. First of all, should it be included? Because somebody should raise this query. This is a removal cost after 10 years. Why we are including in the cost of this PPE today? Because you have to incur this expenditure. That is a condition for acquiring this PPE. Government says if you want to install all your machines in that site, you have to restore the site also. Then you are given that license. So that means this is also a part of this only. Okay. Decommissioning cost is also directly attributable to PP, incurred later, will be paid later. Like in this question which we solved, we are paying later after 3 years. But have you not capitalized the amount payable after 3 years? Yes. So can I not extend the same logic? I have to pay something relating to my PPE after 10 years. So I will recognize to that present value. So we will calculate the present value and add it to the cost of the PP, and then subsequently you will keep on adding finance cost to this liability like we did in the previous question, and after 10 years you will make the payment of that liability. An entity is required to include in the cost of the item of PPE initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located. This initial estimate is correspondingly recognized as a liability in accordance with Ind AS 37. So basically what is the effect? On one hand we are going to debit PPE, the credit will go to provision for decommissioning, restoration and other liabilities. That is how these two chapters are connected now. Initial measurement will be as per the provisions of Ind AS 37. So Ind AS 37 has given you guideline how to estimate your liability. You have to make the best estimate, take into account the technology that is available, okay, etc. Risk and uncertainty involved. Keeping all those things in mind given in Ind AS 37, you will do the estimation of decommissioning cost. Now, decommissioning, restoration and other liabilities expenses. Drawal expenses are capitalized in case of situations like mining, this is mining, oil exploration, okay, this is oil exploration. You have to remove all those machines and equipment that you are installing in the sea, right? Or even nuclear plant. Nuclear plant you have to decommission fully, otherwise it will cause lot of health problem to the citizens in that area, or even hydroelectricity plant. These are examples of major amount of decommissioning cost which companies have to incur. Okay, that once the activity is complete, maybe after 5 years, 10 years, 20 years, sometime 40 years, you have to decommission and make provision now based on best estimate where there are liabilities for site restoration. It is made at initial estimated value. Ultimately it is an estimation, okay, and the estimates will change. This value is calculated as follows. So what we have done, we have tried to make your life simple. In case if they ask you to estimate the provision for decommissioning cost, estimate with some data. What you will do? Step number 1, make current estimate of the withdrawal. This is one way, in case if they don't give you the figure. Sometimes they will only tell you 40 lakh rupees will be required after 10 years. Then you just take the present value. Otherwise, you first make a current estimate of withdrawal. That is, today if I incur that cost, today if I do the decommissioning, how much will be the cost? Material, labor, overheads as expected today. Today, if I do the decommissioning, how much cost I will incur? That you can find out easily. Yes, but then this is today. This is after 10 years. You have to check what will be inflation over this period. Let us say inflation will be 4%. So if the estimate is 100 rupees today, its value after 10 will be 100 into 1.04 to the power 10. Material, labor, overhead cost are not going to remain same. So if you have used today's price level, then after 10 years, increase it on the basis of expected inflation. Similarly, risk premium for the change in the input cost. Plus you also believe my estimate can be different. So I will add 10% to my estimated figure, because you are estimating. Add into 1.10 for 10% risk premium. Because ultimately what happens when you are estimating something which will happen after 10 years or 5 years or 20 years, your estimates are likely to change. So this is the risk premium for that change in input cost, that today I have estimated this, but it can change. So to be on a safer side, let me add 10% more to my calculated figures. Is it right? Then this 4% and 10% are example, don't write in the exam. Some of you, whatever I write, they write that also in the exam. This 4%, 10%, 5% are examples. So this way we will be able to estimate what we will pay on the future date. After adjusting step 2, we will get future estimate of the withdrawal. Okay, so I assume 100 rupees was my cost here. I will find the future value by first adjusting inflation and also adjusting for risk premium. Of course, in the exam you will do all such adjustment if it is given. If it is given, suppose they don't mention about risk premium, ignore it. Okay, so now we have reached here, but I will not make provision equal to this amount. Will I make provision equal to that amount? No, that will be after 10 years. So I again need to discount it back. So I have used some discount rate. What is the discount rate? It will be discounted using cost of equity, that is risk-free rate plus risk premium. So most of the time in the exam, they give you this discount rate. I have seen, even in your study material. But if discount rate is not given, then they will give you some data to calculate the discount rate, like risk-free rate is 5%, risk premium is 3%, which means I will take 8%. Risk premium is taken because again uncertainty is involved. Your cash flow includes uncertainty element. So discount rate will also include uncertainty element, yes or no? If cash flows are full of risk and uncertainty, discount rate will also include the premium for that risk and uncertainty. This will be supplied to you, don't worry. And then after computing step 3, what is your next task? Next task is to compute the present value. This present value, this is your cost, this is your discount rate. present value of that is your initial estimate of drawal, and this initial estimate of drawal will be capitalized by passing the following entry: PPE account debit to provision for decommissioning expense account. Yes or no? PPE account debit to provision for decommissioning expense. So the PPE value will go up, this liability will come in the balance sheet. Then every year you have to pass entry finance cost account debit to provision for drawal. For 10 years you have to pass this entry. This is called unwinding of discount. This is called unwinding of discount. First you discount it, then you again take it back to that place by adding it. So this is your discounting, this is unwinding of discount, right? So now we will continue tomorrow.